Well, Wall Street's fear gauge is at its highest level since pandemic lockdowns in 2020 as stocks tumble on recession fears. Joining us now is Stephanie Pomboy, MacroMavens President. Stephanie, great to see you. So I read your stuff. You were predicting this week that markets would face some blustery headwinds. How much more bluster should investors be prepared for?
Well, thanks so much for having me, you all. It's a pleasure to be with you. I think, a little perspective is always useful. The market post-COVID is up 150%. And everyone is hysterical now that we're down 7.5% from that high. So we're now back to where we were in May. That's, 2.5 months ago. So just a little perspective. This is really very modest in terms of a correction. And frankly, I think it's long overdue. As you know, I've been saying this for a long time. I think that this idea that we might have a recession is sort of like Biden might have dementia. Really? I mean, who didn't know that the economy might go into a recession when we just went through the most aggressive Fed tightening cycle in history? I mean, faster and more dramatic even than we saw in the 1970s. And we did so in contrast to that period against a backdrop of an economy that's incredibly levered, and the corporate sector especially. The corporate market is twice as levered as it was in 2007. And a much larger portion of that debt is of lower quality. Back in 2007, the share of investment grade paper that was rated triple B or lower, which is sort of just one downgrade from junk, was 37% of the IG market. Today, it's 55%.
Wow.
So we have lower quality borrowers that are massively levered, that just endured the most rapid tightening cycle. And we're sitting here shocked that maybe some of them are starting to have problems.
I think, Stephanie, a dose of perspective is always good to put it into context. So I appreciate that. But the way I'm looking at this market, I see three factors that are impacting the selling that we're seeing today. The first would be sort of fundamentals, economy, what you're talking about, in general, some of these, leveraged investors that are out there. The second would be the election. And the third would be geopolitics. And so ultimately, we're waiting and watching today to see what Iran will or won't do with respect to Israel. Our understanding is that they will do something. How much does that impact this? How much could it potentially make it worse?
Well, I would add a fourth, Jackie, before I get into the two that you mentioned, and that is the unwind of the yen carry trade. And I think this is a very huge factor that isn't getting nearly enough attention. We saw the Bank of Japan back in March moved to tightening for the first time in decades, and really signaled a shot across the bow to all these levered speculators and hedge funds that had been funding their levered positions in cheap and ever cheapening yen. And yet, for some reason, they must have all fashioned themselves sort of Soros versus the Bank of England. Even when the Bank of Japan telegraphed they were going to raise rates, speculators borrowed even more aggressively in yen. And then it wasn't until last week when the BOJ tightened again that they realized, hey, these guys aren't joking. Maybe they're really going to try to push rates higher. And we saw the compounding factor of the yen carry unwind that contribute, I think, a large part to our sell-off. But on the geopolitical risks, I think, obviously, that's unforecastable, but just another cloud of uncertainty over this market. And then finally, I would say that the bigger factor in terms of politics would be domestic and the rising prospect since Kamala's miraculous transformation to this pro-growth, tax-cutting, pro-fracking conservative, apparently, that the markets now see that she actually has a chance to win, and that's been a real drag, I think, as well. So we do have a perfect storm of headwinds.
So that perfect storm of headwinds is leading some, like Jeremy Siegel, the very respected professor of finance over at Wharton, to come out this morning and say that he would like the Fed to do an emergency cut of 75 basis points. Curious, though, in your opinion, if that actually spooks markets more, because that's telling us that the Fed sees something very, very difficult on the horizon that we were not preparing for.
Well, Taylor, I would agree with that immediate reaction that, if they came in, especially if they did a 75 basis point emergency rate cut, I think the markets would sell off materially. I would also note kind of on that score, on Wednesday, when Powell gave his press conference, he likely had seen components, not the whole thing, but components of the Friday payroll report. The Fed gets access to those numbers early. So his hair was not on fire when he came to the podium on Wednesday, and his characterization of the labor market was pretty, mild mannered. He didn't seem to view it as particularly dramatic and weakening or, too strong. So he was straight down the middle. And when you look at that in the perspective of the market's reaction to that Friday payroll report, you start to wonder if maybe, the Fed really is going to have a slower reaction function. So I'm with you. I don't think they would do an emergency rate cut. But if they did, I think that would be a real negative for the markets.
I'm going to go back and watch the tape of Jay Powell and see if his hair was smoldering maybe a little bit. It might have been smoldering a little bit. Stephanie, great stuff. Always good to see you.
Thank you so much.